Hi everyone, good day. We are the group 7. I am the host for this video presentation. My name is Rachel Ranyolas. So for today's video, my group will discuss the topic about the derivatives in the Philippines. So first and foremost, we are going to learn first the background of the topic derivatives in the Philippines. Of course, it is important for us to learn first the background before we proceed to the other subtopic. So, the first who will share the background of the topic is Miss Angel Olimpo. Please come in.
So good day everyone. I am going to share to you a little bit background about the derivatives of the Philippines. So a derivative is a contract that derives its value from something else or from the performance of underlying asset or assets. So the underlying asset may either be a market index, interest rate, or other assets like commodities, stocks, bonds, and currencies. So commodities may be oil, gasoline, or gold. Currencies would often refer to the US dollar. So an illustration of interest as an underlying asset is a yield on the 10-year treasury notes. Hence, the value of the derivative is dependent on the fluctuations of underlying assets. So a derivative is broadly defined as a financial instrument that primarily obtains its value from the performance of an underlying variable such as interest rates, bonds price, FX rate, credit spread, among others. So these instruments allow trading in the return of in the return or price fluctuations of financial assets without the necessity of trading in assets themselves. So derivatives are one of the three main classes of financial instruments or securities together with stocks or the equities and debts like bonds and mortgage. However, it was only in 2015, though Circular Letter 2015 to 56, when it is recognized as an investment product for insurers by the insurance company.
I want to call on Miss Jennifer Eleva, who will discuss the reason or the purpose of its existence or the existence of derivatives.
A derivative is a complex type of financial security that is set between two or more parties. For example, traders use derivatives to access specific markets and trade different assets. It is considered a form of advanced investing. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. Special considerations: derivatives are originally used to ensure balanced exchange rates for internationally traded goods. International traders need a system to account for the differing values of national currencies. Assume a European investor has investment accounts that are all denominated in euros. Let's say they purchase shares of a US company through a US exchange using US dollars. This means they are now exposed to exchange rate risk while holding that stock. Exchange rate risk is the threat that the value of the euro will increase in relation to the USD. If this happens, any profits the investor realize upon selling the stock become less valuable when they are converted into euros. A speculator who expects the euro to appreciate versus the dollar could profit by using the derivatives that rises in value with the euro. When using derivatives to speculate on the price movement of an underlying asset, the investor does not need to have a holding or portfolio presence in the underlying assets. So the main benefit and rest of derivatives can be a very convenient way to achieve financial goals. For example, a company that wants to hedge against its exposure to commodities can do so by buying or selling energy derivatives such as crude oil futures. Similarly, a company could hedge its currency risk by purchasing currency forward contracts. Derivatives can also help investors leverage their positions, such as by buying equities through stock options rather than shares.
For our next subtopic, is there anyone here who wants to volunteer to explain to our third topic? So we have a volunteer here who wants to discuss the ruling of derivatives in the Philippines, which is our third topic. Please come in, Miss Millie Rose Pernes.
A market participant may take any of the following roles in derivatives transaction. First is an end user is defined as a financial market participant that enters for its own account in a derivative transaction for legitimate economic purposes. Then the end user may be classified according to its financial sophistication. First is the market counterparty that refers to any UB or KB only with respect to the instruments for which it is authorized to engage in as a dealer. Second is institutional counterparty. Refers to an institution which is not a market counterparty and has a level of net worth. Third is the sophisticated individual end user. It refers to an individual who was demonstrated to the bank as having the level of net worth. Fourth is the other end user. This refers to all other institutional or individual clients not categorized as market counterparty. So, second roles is a broker is a financial market participant that facilitates a derivative transaction between a dealer and its client for a fee or commission. Third is a dealer is defined as a financial market participant that engages in a derivatives activity as an originator of derivatives products or as market maker in derivatives products. A dealer can distribute its own derivatives products, including those of others. A dealer can also act as the broker or end user of derivatives instrument.
Let's tell us, Ms. Janelle Narvasa, the process of derivatives transaction in the market.
The process of derivatives transactions in the market. Derivative transactions include an assortment of financial contracts, including structured debt obligations and deposits, swaps, futures, options, caps, floors, collars, forwards, and various combinations thereof. Derivatives are financial contracts set between two or more parties that derive their value from an underlying asset, group of assets, or benchmark. A derivative can trade on an exchange or over the counter. Prices for derivatives derive from fluctuations and the underlying asset. Derivatives markets provide for price discovery and risk transfer for securities, commodities, and currencies. Derivatives include both standardized, exchange-traded instruments and bespoke contracts negotiated between broker, dealers, and customers that have unique needs that are not easily satisfied by standard products. Derivatives employ two primary instrument forms, futures and options. Options are contracts that require a writer to perform an action if the purchaser chooses to exercise the requirement. An option confers the opportunity for the purchaser to require the action, but the purchaser is not obliged to require the writer to undertake the action described in the option contract. When the end of the option term occurs, if no action is requested, the contract and its potential requirements expire. If the option contract's purchaser elects to exercise the rights conferred by the contract's writer must either perform the action or buy out the purchaser position.
And lastly, let us all hear from Mr. Erkinan Palin, the effect of derivatives to the economy and its society.
The effect of derivative to the economy and its society. The derivative main benefit is to allow the economic agent to manage risk factor by giving them the possibility to hedge against those financial danger. For example, I am a farmer who is going to invest in my sowing my new farm. I don't know what the price of my vegetable when I harvest. So we all know that prices constantly changes. If my tomatoes sell for 40 pesos per kilogram, then I might get profit. But if it is sold for 20 pesos per kilogram, then I will be at loss. On the other hand, a soup producer sitting in the city having the opposite risk. She has to worry about keeping the cost of the input low. If the tomato is too expensive, then her business might shut down. What will we do to manage risk? The soup maker and I will engage in a contract where we will agree to the price of the tomatoes before the harvest. This way, I can be guaranteed of a customer and a certain price, and customer can be guaranteed a supplier. This is the foundation of the derivative market. Derivative helps manage risk. Without the ability to manage risk, many business will be thrown out by the market volatility. It is the same in a larger corporation. Without derivative, they will suffer losses or they are high in their expenses and they will suffer losses. The larger the derivative market, the more business save cost, and the more they hire, and the more they pay for their employee. So, derivative market is very important in our economy and in society. It helps us to manage the cost of the product we buy and we sell. That's all. Thank you.
That's all for our video presentation. I hope everyone learned something new in this subject. Thank you for listening, and may the God bless us all.